Get to Rick Santelli, standing by with the numbers. Hey, Rick.
Hi, good morning. Yes, October read on our consumer price index. Month over month headline expected up 1/10 comes in at 0, unchanged 0, which equals the lowest we've seen on this metric since we hit our high at 1.2. That was in June of 22. That was the highest since '05. So 0 ties. That's the lowest we've been. And if you strip out the all-important food and energy, it's up 2/10. That's 1/10 cooler, both than expectations and the rearview mirror. Year over year headline up 3.2%, 1/10 lighter than expectations, a 0.5% less than the 3.7 look last time. 3.2, just to put a face on it. 3.0 in June of this year was the lowest since March of 21, so we're still above that level. And finally, what I would consider potentially the most important, even though it's ex-food and energy, is year-over-year CPI, 4%. 1/10 lighter than we were expecting, 1/10 lighter than our last look, which was 4.1. And the metric there, and this is a biggie, we haven't been under 4% since May of 2021. Yes, under 4% since May of 2021, although this is the lowest level since 6.6, which was a high watermark in September of last year. Now, if you look at the markets, interest rates have moved down. We moved from basically 461 in 10s down to its current level at 447, which equals our intraday low test that we had last week. So you want to pay particularly close attention. And the pre-opening Dow futures have moved higher as well, dramatically higher as well, like 300 points higher as well. So this number is being taken as a good sign, and I understand why, especially if you look at the month over month and you start interpolating out. But I will still leave us all with the notion that 4% year over year, X, very important food and energy. And by the way, all these stories about EVs and power grids and losses on transition, they're not going away. These numbers for energy and pockets of energy are going to stay firm. But that is the number I think is important. All the metrics have moved lower. And as I said, even though all of these have moved lower, they haven't really taken out, other than the headline equaling the lowest level since our high water mark. The others still are comping above levels that were lower. The 3.2 is obviously good news, but as I said, it was 3% in June. We want to pay more attention to how this transitions into the actual opening, but we'll toss it back to the panel to debate some of these numbers. Joe, back to you.
Yeah, immediate reactions, though, and pretty bigger than we've seen recently. Stay with us. Let's bring in our senior economics reporter, Steve Liesman, along with Joe Lavorgna, chief economist at SMBC Nikko Securities, and Kitty Richards, a former Treasury Department official under President Biden, also served as an economic advisor to the president when he was vice president. Steve, we'll go to you first. And I think one of the things Rick said was that 4.5 we saw has been breached on the downside for the 10-year. So that sort of, I don't know, that's kind of like a confirmation of that move maybe at this time because of the CPI number.
Yeah, I think that's right, Joe. There has not been a lot of inflation in the move up in interest rates, and it's interesting to see some move down in it. It's not quite there yet, but we're still quite a bit above financial conditions being tighter. But this is a good report. There were some surprises to the downside, and it's been a bit since we've had surprises to the downside. We're incrementally making progress towards the Fed's goals here. One of the big standouts here was the owner's equivalent rent, which is the proxy for housing, down to 0.4% after 0.6%, surprising to the upside in the prior month. You got gas down 5%. That's headline stuff, not really a big issue. Used cars down 0.8%. That's a big number there. Physician services also down 1%, while hospital services were up. And just one quick, airline fares down 0.9%. So that probably comes along a way that energy seeps into the service sector. So I think that if you were to draw, let's say the Fed was equidistant here between hiking and not hiking, this is an incremental move towards not hiking again. So I think the market likes it that way, Joe.